Ladies and gentlemen, good day and welcome to the Q4 and FY25 earnings conference call of SG Mart Ltd, hosted by Emkay Global Financial Services Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harsh Pathak from Emkay Global Financial Services. Thank you, and over to you, sir.
Yeah, thanks, Pooja. Good afternoon, everyone. On behalf of MK Global, I would like to welcome the management of SG Mart and thank them for this opportunity. I shall now hand over the call to Mr. Anubhav Gupta, Group Chief Strategy Officer, for the opening remarks. Over to you, sir.
Thank you, Harsh, and thanks to MK Global for hosting SG Mart for its Q4 FY26 earnings call. Good afternoon, everyone. I welcome all of you to our earnings call. Along with me, there is a whole team of SG Mart which got built over the last 1.5 years since we started the business. I am glad to welcome Mr. Amit Thakur, who is a director and he heads our B2B metal trading. Mr. Archit Arora, who is Vice President Marketing, and he heads our service center business. Ms. Anamika Gulati, who joined recently to take care of our renewable business, and Suraj Kumar, who is our CFO, and Naman, who heads strategy and IR. And of course, Mr. Shiv Bansal, who is the joint managing director, and he heads the distribution business of SG Mart. Now, coming to FY25 earnings call, this was the first year of full year operations, wherein we did around 5,800 crore of revenue with 103 crore of EBITDA and 103 crore of net profit. We are excited to tell you that we could create this franchisee in last 18 months since we started the business in 2023. And today I'm proud to tell you that we will be amongst India's largest trading house, with 100% of this 5,800 crore revenue flowing through P&L. There is no GMV. It's 100% flowing through P&L. And today we are servicing 2,257 customers, and we are procuring raw materials from 225 suppliers, which consist of large steel mills, large mills for zinc and billets, plus MSME and small manufacturers who are producing multiple products. I can tell you with full confidence that this EBITDA of 100 crore will grow to 200 crores in FY26 and 400 crores in FY27, as we double our business every year in terms of expansion in each of the verticals, and this will be coupled with minimum threshold of 25% ROC. Like we have always maintained that for the first 3 years of SG Mart, we will be focusing mainly on steel trading as a product, and the same is visible in our FY25 performance plus the guidance for FY26. Currently, our goal is to buy steel in bulk and become the largest buyer of steel in the country. So this will take care of the procurement part. Then comes the sales part. We have segregated our sales into 3 verticals for raw steel, which we are buying from steel mills. Number 1 is pure B2B metal trading. We buy in bulk, we sell in bulk to large clients. Second vertical is to sell through network of service centers, where some mild processing is done for the steel, and then steel is sold to multiple customers, multiple factories. This will be done through a network of service centers which we are creating right now. The third vertical is to sell steel in form of solar structures. Again, this is mild processing, and we will keep on adding products to these verticals as we buy more and more steel. Idea is to idea is to process steel in some way and get extra margin over it, because B2B trading always will have limited margin, but when we do mild processing and service the industry, the margins become 2x and 3x, and it adds up to the ROC. The good part is that all steel mills, when we hear the commentary from them, they are bullish on the expanding steel volumes, because more and more steel capacities are coming online, whether it is flat steel or long steel. Now coming to the vertical wise, B2B business, we are doing around 50,000 tons per month volume, and we expect a sharp ramp up in second half as more steel comes online. This will grow by 50% next year. Then the service center business. Right now, 5 service centers are operational. One in Raipur, one in Bangalore, third one in Ghaziabad, fourth one in Dubai, and fifth in Pune. Now this volume will double as we add 5 more service centers at the identified locations such as Jaipur, Kanpur, Patna, Siliguri, Ahmedabad, Indore, Bhubaneswar. What we believe is that India lacks the network of service centers. Right now, what happens is there are mom and pop unorganized service centers which are spread across industrial clusters, but we believe that formalizing the network of service center throws up a massive opportunity, wherein you buy steel and then process it and sell to multiple user industries. Now the third vertical which we started is very interesting, which is solar structures, because again raw material availability is the most critical component here. Now that's where SG Mart strength comes into play. For the sales, we have launched a brand called Sun Steel, and we have started selling to large independent power producers who are setting up massive solar utility parks, and we already have 50,000 tons worth of order visibility, which will be executed in FY26, and this will easily double in FY27. Now the fourth vertical of SG Mart is the distribution business, which was established to leverage APL Apollo Group, which is having a massive network of downstream steel distributors. Now the products here what we sell are TMT and light structural and other downstream products. If we come to TMT, we are doing a monthly volume of 11,000 ton a month, which will increase by 50% in FY26. And the other products, which consist of light structural, mesh net, binding wire, etc. These products, we are right now doing 40 crore of monthly run rate, which means around 500 crore of annual sales. But in FY26, we expect this revenue to reach 1,000 crores. So, which is again doubling over the current run rate. Now, if we add up to these numbers for all the 4 verticals, our confidence is that we can hit 200 crore EBITDA in FY26, and solar is a new vertical. It will add up to the revenue. So we believe that any profits could be over and above 200 crore of EBITDA, which we believe will come from the 3 verticals, which are B2B trading, service centers, and thirdly distribution business. Now coming to cash flow, our working capital for FY25 March looks a bit stretched at 30 days. Now this is because of 2 main reasons. One is that we made a lot of advance payments to the steel mills towards the last week of March of 2025 ahead of the tariffs which were coming, which were being imposed by the government for import of steel. So almost 10 days of working capital got stretched out of it. Now that has already got released in May. In May, the working capital is already normalized, and also because of uh, good demand visibility in the last few days. So some sales also shot up, right, which increased our debtor days. But again, that also got realized. So in the June quarter, we are confident that the working capital will come back to 10 to 15 days, which has always been our target. Now, lastly, just on the CapEx commitments, which is mainly for the service center. Like I said earlier, one service center requires 30 to 40 crore of investment depending on tier 1, tier 2 cities, and very minor investments to build solar capacity, because that's not a CapEx intensive business. So for next 2 to 3, 4 years, we have taken board approval for the required CapEx commitment. One thing I can assure you, that whatever CapEx we do every year, that will be fully funded from operating cash flows. We don't need any external capital or even debt or even the fixed deposit which is lying in the banks. This CapEx for service centers will be 100% funded from the internal cash flows. So all in all, I would like to reiterate that we are proud of what we have created SG Mart in the last 18 months, and the verticals which have evolved, and the tie-ups with the steel mills for steel, and the way we are selling steel in multiple forms, catering to multiple sectors, and the client base of 2257 base. This will keep on getting increased as we expand our business by 100% year on year. With this, I would like to open the floor for Q&A. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohan Baranwal from Arihant Capital. Please go ahead.
Hello, am I audible?
Please go ahead.
Yes, sir. You
Yeah.
are.
Sir, can you please describe the recent, like the recommended 12% restrictions on the import from safeguard duty from China, and how it affects the company's overall portfolio, sir?
Rohan, see, SG Mart, the basis of SG Mart was to capitalize on the increasing domestic capacities in India, right? Because what we know is that from 2019 till 2023, the domestic capacities were not expanding. It was like mainly stagnant. And from 2023 till 2027, there was almost 70-80% increase in the steel capacity, which had already got announced, and the mills had started to come online, right? So our focus was always to do long-term tie-ups with the domestic steel mills, right? Where the supply is more rational, it is more organized, right? And imports, yes, imports are always like opportunistic, right? You can't build your business model, sustainable business model on imports. That's why in India, the largest steel trader used to be like doing volume of 25,000 ton a month, right? Because imports will always depend on the gap between domestic and international prices, which keep on fluctuating. So as far as SG Mart is concerned, it is not impacting the business model as such, because our business model is standing on the thesis that in India itself, the existing 6 steel mills are increasing capacities a lot, and we want to capture that volume rather than relying on imports where the sustainable supply is always a challenge.
Okay. And sir, in Q3 con call, you said that you had issues with importing from China because of the 90 days period to wait. And you were also building up tie-ups with Indian manufacturers. So how this has been going forward, sir? And also one last question, and after I'll join the queue. The second question is the previous uh, like uh, your guidance on adding up the service centers was around 10 to 12 service centers adding year on year basis. But it has been while I was looking into your recent presentation, investor presentation, it shows you will be adding around 5 to 6. So is there any issues with adding up new service centers or any difficulty in getting land acquisitions and all? So that's it. So
Right. So coming to the first part, today we are buying steel from 4 out of 6 steel producers in the country, right? So this captures almost 60-70% of the supply, right? So the tie-ups with steel mills are going ahead as per the plan. Imports, like I said, it is opportunistic, okay? But obviously after tariffs, so now in FY26, the whole industry is not going to be dependent on imports, and so is for SG Mart. Coming to the second question, service centers. So see, I mean, earlier we used to feel that a service center can do volume of 3 to 4,000 ton a month, right? And that's why we wanted to open more number of service centers. But what we have learned by operating 5 service centers is that one service center now can do business of 8 to 10,000 tons. If you look at the capacity is around 12-13,000 ton a month, right? And you can easily get volume of 8 to 10,000 ton a month. So that's why if you look at the volume from service center, that we have not reduced, but number of service centers we have reduced because from one service center you are able to capture more volume. So there is no point putting capex into service centers which will remain idle. Idea is to sweat the existing service centers to the fullest of their capacities and then go for new service centers.
okay, sir. Sir, thank you. I will join in the queue.
Thank you. The next question is from the line of Akshit Gupta from Oaklane Capital. Please go ahead.
Hello. Congratulations on your good set of numbers on margins and the growth. I have one question regarding the advances to steel producers. So, like we have done advances to steel producers, will that help with procurement efficiency and the pricing, which could indicate which could increase the margin in Q1 FY26?
So it should, right? But the main idea was to book steel, right? Ahead of tariffs imposition. So to answer your question, yes, there could be some benefit, right? But at least we had secured the supply, right? Because imports were going out of the country in Q1, and if you don't have the steel supply to service your clients, so that could impact your business. So our mindset was more to secure the supply of steel rather than going for short-term benefits.
Okay. And on the I was seeing just the peers in this in this segment, they are entering a lot, and all they have a e-commerce platform. So are we planning on the same line to build an e-commerce platform so that a consumer can easily place an order on that?
Please understand that right now our customer base of 2,257, okay, they are mainly B2B clients, right? Who are running factories, who are steel traders, who are operating small service centers, who are now independent power producers for solar. Such transactions are normally closed, like, on the personal relationship with our salespeople. Okay, so I would say right now the business model is brick and mortar, and that's how this business is done, at least in India. But we are using tech stack, right, to ensure the efficiency in our systems. So the orders get punched online, right? The tracking of orders, our supply chain efficiencies due to tech stack, right? So all those systems we are implementing, but the end transaction is always done from sales guy to the customer.
Okay. And one question on the B2C segment that we do. So that segment I was seeing there is not much of the growth, but we have guided for 6,000 crore of revenue in FY27. So are we on the same line, or is there any corrections in the guidance?
Also in distribution business, okay, which consists of two verticals, TMT and non-TMT. So what we were doing was that, for TMT, we have done tie-ups with the manufacturers who used to sell TMT on our behalf to their clients and to the network of APL Apollo Group distributors. That revenue was flowing through our P&L, but now we have changed it to royalty-based model, wherein the revenue doesn't get booked into my account, neither the cost of material. It is only the royalty which gets booked into our account. So right now we are charging around rupees 500 per ton royalty from these TMT partners, and as the brand gets established, more volumes come into play. This royalty we expect it to increase to 750 and rupees 1,000 per ton eventually.
Okay.
Just to clarify that TMT we have given the volumes, right, which is around right now 33,000 ton we did in Q4, right, and for full year the volume was around 100,000 tons, 107,000 ton to be precise. Now for FY26 our target is 180,000 ton for TMT. This will not now here only rupees 500 per ton royalty will get captured into revenue, right? And for non-TMT, because there are multiple products, so volume doesn't make sense. I'll talk about the value of revenue, right? So in Q4 we did 130 crore revenue, right? And for the full year this revenue was 380 crore. For FY26 our target is 1,000 crores.
Okay. So like we have shifted to a royalty-based model. So because of this, we would be having a better EBITDA margin compared to the previous model, right?
This is one, and second, then the sale, the debtors, everything gets shifted to the franchisee partner. Nothing comes on the balance sheet of SG Mart.
Okay, I will come back in the queue.
Thanks.
Thank you. The next question is from the line of Shiva from Purnartha Investment Advisors. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah. Good afternoon, team. My question is with respect to the solar. If you could just explain slightly that 600 crore capex, why are we, how much is the breakup? Is it entirely capex? What are we putting in? What kind of revenue are we expecting? What kind of profitability? If you could just throw some data to understand it better.
I guess there is some confusion. I said that in my opening highlights that this 600 crore capex is for next 3 to 5 years, which we took the approval from board, right? So every year it's going to be like, say, 150 to 200 crores. Now, this majority of this capex is for service centers, right? Like I said, one service center costs us around 30 to 40 crore in terms of fixed assets, right? Every year we open 5 to 6 service centers, so 250, 300 crore of capex will go into service center. For 3 years, we will consume this 600 crore approval which we took from board. For solar, the capex is very, very minimal, right? Our capacity for solar will be operational at 15,000 ton a month, which is 200,000 ton a year. Now the capex for this is very, very minimal, right? Because it is more of mild processing, right? And the best part is that these profile machines are being installed in the existing service centers, right? So I need not invest into any land or factory sheds, correct? So this 600 crore is not for solar; it is mainly for service centers, and this we will use in the next 3 to 4 years. And I am rehashing that any capex what we do annually, it will be funded from operating cash flows. We don't need any capital, any debt, or even the current fixed deposit which are lying in our banks to fund the capex. Whatever operating cash flow we make every year, we'll use it for capex.
Okay, so to understand firstly, so the earlier thing of 5 service centers, that is the only capex. There's no additional capex of 600 crores. It's the same
very
plan.
Minimal capex on solar. That is right.
Okay. And with respect to Dubai service center, if you could throw what is the amount we've invested, because we've taken another loan, I think we've given. So if you could just tell me what is the total amount of investment we've done in Dubai till date, what is the kind of revenue we are earning and the profitability?
So Dubai capex is around 60 crore, which is slightly higher than a service center you set up in India. Volume we are doing is around 10,000 ton a month. Margins are also a bit higher there, so that takes care of our threshold ROC of 25%.
Okay, but because in the standalone numbers it looks slightly higher in the balance sheet. If I just do, so what is covered in the investments and the loans part of this part?
Right. So capex for Dubai,
because it's 167 investments and 147 crores of loans.
Yeah, so loans, loan will be to fund the working capital in Dubai, right, which is slightly higher than India operations. And capex gross block investment is 60 crores.
Okay, so that's 300. So what all consists of the investments and loans of 300 crores that we have on the balance sheet?
Okay,
it's 60 crores capex and another 40 crores of working capital, so that's like 1,100 crores.
And out of that, there is a 110 crore in the cash balance. It comes in the month of April.
So this amount consists of 110 crore of cash balance in Dubai entity.
Oh, so we have additional cash of 110 crores in that.
That is right. 60 crore of gross blocks investments, and rest is short-term loans for working capital.
Okay. In the long term, what is the kind of revenue that we're expecting from Dubai and the profitability?
So Dubai, Dubai, like I said, we are doing 10,000 tons volume a month, which translates into 60 crore of revenue a month, right? Yearly, you can calculate 600-700 crores, and margins are higher than what we earn in India. So in India, we earn around 1,800 to 2,000 rupees a ton easily. Dubai is slightly higher than this.
Okay. And just wanted to understand with respect to the peer, like JSW1 also has the steel trading. Just wanted to understand how are we different from them in that particular segment of trading, JSW1 and us?
Honestly, we have not analyzed the business model of our peers, right? But what I can tell you is the opportunity what lies in the country for metal trading, right? It is immense, and we believe you need at least 10 SG marts, right, to service only steel sector, right? The way the capacities are getting built up by 2030.
Understood. And just wanted to understand a bit about the trade.
Sorry to interrupt.
Yeah, I'll get back in the queue.
Yeah.
Okay, sure.
Thank you, sir. Thank you. The next question is from the line of Rohit Singh from Invest Analytics Advisory. Please go ahead.
Hello, I am audible?
Yes, sir.
Thank you for the opportunity. My first question is, earlier the revenue target was 18,000 CR for FY27. But now with the 50% CAGR guidance over the next 3 years, it appears to 18,000 milestone will only be achieved by FY28. What is the reason for this delay? And has the growth trajectory changed, or is this a strategic adjustment?
I told you that from 100 crore EBITDA in FY25, our EBITDA will be 200 crore in FY26 and 400 crore in FY27, right? So which matches the earlier guidance of 18,000 crore revenue, right? So what has happened is that the steel prices are down by 10 to 15% at the time when we gave the guidance, right? But our EBITDA per ton and EBITDA is intact. So that's why I'm saying that 400 crore EBITDA in FY27 is achievable, and we will do it.
Okay. So my second question is, in Q4, our margin declined primarily due to rising interest costs. As a result, despite top line growth, we are not seeing corresponding EPS growth. How do we expect this to evolve going for next year onward? What is the outlook on interest cost and margin recovery? And how do we plan to ensure EPS growth aligned with the revenue growth?
The interest cost is going up because we are using the funds which are lying in the as a fixed deposit in the balance sheet, right? That's why the interest cost is going up. In 2026, when we guide for 100% growth in EBITDA, same 100% growth in PAT also you will see.
Okay, sir. That's
Thank you.
Thank you. We'll take our next question from the line of Amol Rao from One Up Financial Consultant. Please go ahead.
Thanks a lot for the elaborate guidance and very, very clear presentation. I've got two questions. Firstly, on this royalty-based model, when we charge a royalty to these third-party manufacturers for using our brand, is there a take or pay kind of an arrangement that is there, or is there a minimum guarantee of sales that is there, which is why we are able to charge this royalty, or is there some other arrangement in play?
Of course, Amol. So we do have MOUs signed with our partners, right? We do tell them that you need to sell minimum quantity of TMT, right? Every month, every quarter, every year, and based on the market mapping, because we have our own team of salespeople which is also on ground. So there is a clear visibility on the volumes, minimum volumes, what we must do every month, right, with that partner, and on that basis we get the royalty.
Perfect. So we are basically guaranteeing them a certain minimum utilization on a rolling basis, so that they can take care of their costs and profits, and that's why we get the royalty basically for our brand.
That's right.
Okay.
Yes. And just to add to it, the reason they are also doing this happily, because before joining hands with SG Mart, their own utilization levels were very, very low, right? So their cost of productions were high, their fixed costs were high because of that. Now that with SG Mart, they can visualize that, okay, utilization level will go to 70-80% from 50%. So their cost of raw material, cost of production, everything goes down, right? So
Perfect.
they don't mind sharing that 500 rupees per ton right now, right? And when APL Apollo SG TMT goes in the market, so that also commands some premium compared to the peer brands which are available right now, right? So that royalty does not pinch them, right? Either they derive it from the lower cost of production, or it is from the premium what they get by selling in our brand.
Perfect. Well taken. Second, Anubhav, on the service center business. So, I mean, we've seen a very good ramp up. We've seen the margins also improve because of that. I just wanted to understand on the working capital side of this. Now, we'll be doing primarily CTL business through this, right? CTL and some cut to size also probably at some later date. Does this involve a slightly larger or slightly higher working capital cycle than our steel trading business, maybe by a few days? Because the inward shipment processing and then outward shipment would require a slightly larger this thing, because the other one is built to ship to, right? So slightly larger working capital cycle requirement.
So definitely, Amol, right? The working capital in service center will be slightly higher than B2B metal trading. But again, in B2B metal trading, if we are earning, say, 1.5% EBITDA margin, in service center, we earn 4% EBITDA margin, right? So what we ensure is that the service center business should generate minimum 25% ROC. And the math says that, say we spend 40 crore on gross block, right, investment service center, it does 8,000 ton a month, right, and having working capital requirement of 20 days, so it will need around 25 crore of working capital, right? So the total capital employed will be 40 plus 25, which is 65, and on that we will be earning EBITDA of minimum 20 crore rupees.
Yeah, so the math works out. All right, but my point is the increased working capital out here gets balanced out by the TMT business and the B2B metal trading business, which is also growing. So I think we're confident of maintaining overall our cash flow conversion. I was leading towards the cash flow conversion cycle, which because of whatever reasons went up to 30 days this year, could probably revert to 15 to 18 days by the end of next year. That was where I was leading to.
Within June only you will see this rationalization.
All right. And Anubhav, may I squeeze in a last question, please?
Yeah, please go ahead.
Yeah. Anubhav, the solar structure business is pretty interesting. So, but this is compared to a lot of other metal-based businesses, this would require some amount of, let's say, precision, slightly more precision than other metal activities, metal forming activities. So this is done in our service centers, or are we doing it slightly separately? It's being done only in our Ghaziabad facility right now.
Yeah. So we're gonna do it in 3 locations, Amol. One in Ghaziabad, which is already operational, right?
Okay.
Then we're gonna install some mills in Pune, because that will take care of Rajasthan and Gujarat belt, right? And we'll also install some machines in Raipur, right, where the raw material availability is better. And then we will also set up some lines in our upcoming Hyderabad or Chennai service centers that will take care of Karnataka, Tamil Nadu, right? So if you look at the maximum utility solar parks coming, they are majority in Rajasthan, Gujarat, then Tamil Nadu, Andhra Pradesh, Telangana, Karnataka, right? So we have to see that from all these locations we are able to service our IPP clients efficiently.
And this is only the module mounting structure, the MMS part of it, right? Nothing else. We're not doing anything else, right?
That is right. We are working on some new innovative products also for solar sector. Now that our interaction with IPPs is very, very intense, because these structures, although it accounts for only 3-4% of their total capex, but it's a very critical element, right? So we are just talking to some solar panel manufacturers that how steel profiles can be used, right, to bring down the costs for solar panels also. So maybe in next quarter call we'll be able to tell you more in detail. But idea is to keep on working on these small profile machines, right, and expand the market.
Perfect. Thanks a lot, and wish you all the best. Thank you so much.
Thank you. Participants, in order to ask a question, please press star and one now. The next question is from the line of Ayush Vimal from Clearview Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. I had a couple of questions on the royalty model, which we shifted to in the downstream distribution business. Now, given that we are selling TMT bars and royalties, are we taking or assuming the credit risk on behalf of the small plants for whom we are guaranteeing minimum volumes? Or that's something that we are not assuming now, given that we are drawing royalty and there's no working capital on our books?
Yeah, so there is no working capital on our books, right? Royalty, anyways, the agreement says that the day sales is completed, he has to credit royalty in our account.
Got it. So we are effectively just connecting the seller and the buyer, and we are not assuming any kind of credit risk here.
Correct. So yes, so that is real marketplace, right? The only difference is versus other peers that we are not capturing this into our GMV. So there is no GMV, right? Gross merchandise value, because it unnecessarily confuses everyone.
Got it. And given this TMT, being quite a sizable business in the downstream distribution product chain, I would have expected the target EBITDA margin of 2.5% that you've given to go up higher, given the fact that you shifted from a revenue-based model to a royalty-based model. I presume earlier you were mentioning the target EBITDA from this stream of business to be 2.5%, and this was when we were taking stock in our books and we were actually distributing TMT parts. Now, given that we moved to royalty, shouldn't this 2.5% increase rather than falling to maybe 2.5% that you've given?
Yeah, so definitely it will go up, but why guidance is a bit low for margins, because we need to keep on investing on the brand building, right? So idea is to keep on investing into brand building and take this royalty from 500 rupees per ton to 1,000 rupees per ton. That's our ultimate objective. So it's just that for this year we're going to be spending a bit more. Right, but once the brand is built, then yes, margins will move towards 4 to 5%.
Got it. And just one last question on the receivable days. So I've seen the receivables have shot up in the March quarter, and you've said much of this has been reversed in June, and this was more of a one-off. Which segment has been driving this receivable days? Is it the downstream distribution business or the B2B metal trading business?
Yeah, it was mainly like B2B.
Okay. From what I recall, you were very clear that you didn't want to give credit days in the B2B business given the thin margins. Has something changed in that policy?
No, nothing changed. It is just that 3-4 days credit you offer to client, right? And like I said, this last week was quite voluminous, right? So the money came into account within first week of April.
Okay, got it. So we should see this normalizing in June end.
You will see 10 to 15 days of WC by 30th June. Yeah.
Got it. Thank you.
Thank you. We'll take our next question from the line of Riddhesh Gandhi from Discover Capital. Please go ahead.
Hi, sir. Congratulations on your results. So we've got reasonably ambitious and aggressive growth targets going ahead of doubling for 2 years in a row in terms of EBITDA. Just wanted to understand the risks involved in this and how we are able to get the confidence over this kind of growth.
Fair question. See, I mean, the confidence comes from the two things. One is the number of customers what we are servicing right now, and the new customers what we are adding every day. Now, the second part is the products what we are selling and new products what we are adding every day, right? And if you look at our business model, it's built with the thesis that that you have steel as raw material available, then you sell it into sell it through multiple verticals. So the only risk to this could be non-availability of steel, which we don't see as a challenge, right? Other risk, we don't have any debt. We don't have debtors on books as such, right? 10 to 15 days debtor cycle is very much manageable. We don't carry high inventory, which the fluctuating steel prices could impact, right? So in that way, we have created a business model which is shock-proof, right? From any of the global uncertainty or any massive swings in the steel sector, right? Our focus is that what all small, mild value additions we can do in steel sector and grow our market share, capture new markets.
Yes, sir, I get that just given how we are structured, our relationships across the industry, both on our customer and our supplier side, we are all faced well. But in terms of what is and that the downside is low, but I mean, what is giving us the confidence on the growth angle of things? Because these are quite large numbers we're talking about.
Right. So okay. So see, so this year, FY26, right? Let's talk vertical to vertical. So number one vertical is service center, right? So FY26 will be full 12 months of 5 service centers which will be operational. Now 5 service centers, one service center will give us 8,000 ton volume. So 40,000 ton monthly volume will come, which means 500,000 ton per year. And on service center, we do make 2,000 rupees per ton EBITDA. So 100 crore EBITDA will come from service centers. Next year, more 5 service centers will get added up, right? That will bring additional 5 lakh ton of volume and incremental 100 crore of EBITDA in FY27. Second vertical is B2B, right? So B2B, we did volume of around 3,22,000 ton in FY24. And 632,000 ton in FY25. So it has already doubled, right? For FY26, we are projecting mild growth because, like I said, more of steel will be coming in second half, right? So we will see very sharp ramp up in second half of B2B metal trading. Now TMT, we are doing around 11,000 ton a month, right? The current run rate. In FY25, we did 107,000 ton in total. And our target for FY26 is 180,000 tons, right? Solar structure is 50,000 ton of totally incremental volume, which will come in FY26. Non-TMT distribution business, we did revenue of around 400 crores, 380 crore to be precise in FY25. And for FY26, our target is 1,000 crores from this particular.
Got it. Okay.
Right. So this guidance of 100% increase YOY is after a lot of thought process, right? A lot of work what we have done in each of the verticals, right? The raw material tie-ups what we have with, like I said, 4 of the top 6 mills in the country, assuming no import is coming, right? And then selling that steel through each of the verticals into multiple forms.
Got it, sir. Thank you and all the best.
Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to two per participant. The next question is from the line of Dharmil from Dalmus Capital Management. Please go ahead.
Hi. Thank you for taking my question. The question was more on the TMT segment. So you mentioned that 500 per ton of royalty right now. If we compare it to the GM, it comes to only 1%. And even if we assume at 1,000 per ton few years later, it would be only 2%. And assuming some employee cost, some marketing cost, this comes to a very low margin business than what we had earlier anticipated. So is there any misunderstanding on my part or? Hello.
Yeah, so you are right that that 2% EBITDA margin that was on the NSR of TMT. Okay, that was on the NSR of TMT. But when you calculate the EBITDA margin on 500 rupees per ton royalty, that will be much higher. Because the fixed cost here is only the sales people what we have given to these franchisee partners and our spends on the branding.
Understood. Yeah, I get that point that reported EBITDA margins would be much higher because we are only recording the royalty. But just looking from a business perspective, I mean, is it a low margin business? Just maybe 1.5 to 2% on GMV at best.
Yeah, that's right. But then GMV we are not capturing anywhere, right? So on 500 rupees per ton royalty, the margin will be much higher after deducting the brand expenses and the sales people cost.
Thank you.
Thank you. The next question is from the line of Rajesh from KRS Investments. Please go ahead.
Yeah. So I had a couple of questions. One, I wanted to know is from the listing perspective, so you are right now trading only on BSE. Wouldn't it be a good idea to also list yourself on NSE so that there is more participation in SG Mart?
So that process is already on.
Okay. The second question was with regards to your projection that you intend to hit a target of around 8,500 crores, which means, and since we are almost like halfway through this particular quarter, do you see that SG Mart will be able to cross at least a minimum target of 2,000 crores so that they are able to hit a profit of 48 to 50 crores to stand a fighting chance to get that 200 minimum profit that we're looking at this year?
What I can tell you is that we'll be near about 50 crore of EBITDA in Q1 of FY26. Revenue, very difficult to predict because of fluctuation in steel prices.
Okay. One of your competitor in the unlisted space is basically into similar business and had clocked around 24,000 crores revenue last year with a profit of around 600 crores. And they are kind of, planning to go with an IPO later in the second half. With a valuation of around 60,000 crores to 80,000 crores as per news. So which basically kind of reflects that SG Mart being in the similar kind of business is quite undervalued with the kind of targets that you're mentioning over the next couple of years. Do you think that this basically is something which will show interest in the overall investor community going forward?
Our job is to deliver on the guidance what we are giving to you, right? Valuations, obviously, investors and analysts are smart enough to value these businesses, right? As management, what I can promise you is that day and night, 24/7, our goal is to ensure that we are able to achieve these numbers which we are promising.
And these numbers are, sir, conservative in nature or like the minimum that you are going to target, or is it an aggressive target you have given to yourselves?
So 200 crore EBITDA target in FY26 does not capture any profitability from solar.
Thank you. Sir, we request you to rejoin the queue for follow-up questions. The next question is from the line of Rahil S. from Crone Capital. Please go ahead.
Hi, sir. Good afternoon. Can you hear me?
Yeah, go ahead.
Yes, hi. Did I hear you correctly when you said that you're also looking at 100% growth in your PAT, or is it just for the EBITDA?
No, so PAT will flow in the same way as EBITDA.
If you can, explain how that's going to happen.
So, see, the cost below EBITDA is interest and depreciation, right? Depreciation will be very mild increase, right? Because capex, which will be live for this year, is 200 crores, 250 crores, right? Which could entail depreciation of 10 crore rupees, right? And other income should remain high because of any capex which will be funded from the operating cash flows, right? And the fixed deposit should remain where it is. Plus, there is around 250 crore which is coming in the company in next 10 days on the conversion of warrants. So the cash position of the company should remain high, what it was in FY25.
Things will lead to the PAT.
Sorry to interrupt you, sir. We request you to rejoin the queue for follow-up questions.
Yeah. Just to end the last one. Yes. So PAT growth will match the EBITDA growth.
For FY27 as well.
That's right.
Okay, got it. Thank you. I'll join the queue.
Thank you. The next question is from the line of Akshat from RSPN Ventures. Please go ahead.
Hi, thanks for the opportunity. So my question is a bookkeeping question. So from the previous March 24, we have increased our gross margins by around 700 bits, but our EBITDA margins have fallen by 200 bits, majorly because of increase in other expenses. So can you throw some light on this? Why is this happening, and how do you see this trend going forward?
So percentage margin is a bit deceptive in our business, right? Because NSR keeps on changing as the steel prices fluctuate, number one. Number two, other expenses are a bit high because of expansion of service centers, which is going on, right? So once we start getting income from service centers, which we got in Q4, Q1 it will ramp up further, Q2 it will be further ramped up. So that will nullify the higher other expenses. So going forward, in terms of percentage, it becomes a bit difficult, right? But what I can tell you is that on B2B metal trading, right, we should be doing around 750 to 1,000 rupees per ton of EBITDA. On service center, we should be doing around 2,000 rupees per ton EBITDA. On solar business, anyways, we have not captured any earnings in FY26, but it should be like minimum 3,000-4,000 rupees per ton EBITDA business. Then on TMT, we are getting 500 rupees per ton royalty. Right now, we are building brand, right? So margins will be slightly lower, but they will expand in FY27, FY28. Then the non-distribution business, non-TMT distribution business, where we will do 1,000 crore of top line in FY26. There I can give you EBITDA margin guidance because it is including multiple products. So there we should make minimum 2.5% EBITDA margin.
Thank you, sir. We'll take our next question from the line of Nikhil Porwal from Perpetual Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. All my questions have been answered. Anubhav, only one question is between the rest of the service center business and the solar business that you're getting into. Is the ROC profile more or less the same, or is solar a more attractive business?
Solar is a bit attractive because the investments are very, very minimal. Anyways, we have land and infrastructure available at our current service centers, right? If at all, the idea is to, and 200,000 ton capacity we have already, ordered, right, which will be live by August, September of 2025 calendar year. In next 2-3 years, there could not be more than 50-60 crore of further investments into solar. So solar is better in terms of ROC.
Okay. And in terms of working capital, is it the same for both?
Yeah, it will fall into 15-20 days of cycle.
Okay. That is it. Thank you so much and all the best.
Thank you. Ladies and gentlemen, in the interest of time, this is our last question. I now hand the conference over to the management for closing comments.
Thank you, everyone, for joining to this earnings call. If anyone is left, you please reach out to our investor relation team, and we will get back to you immediately. Thanks so much.
Thank you.
Thank you. On behalf of Emkay Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.